President Trump says he has a plan to make gas more affordable.
It's called Drill, Baby, Drill.
There's no question that the United States needs more energy.
The mandate for the Trump administration domestically is to lower gas prices.
In the first month of his second term, the president announced several executive orders to support this goal. The directives seek to increase the supply of oil, speed up permitting for new projects, pause green investments made during the Biden administration, develop major projects in Alaska, and loosen up regulations for the U.S. oil and gas industry.
We're going to have to be able to build new things, to build big things, and we can't do that because the permitting process is so fundamentally broken.
But the prices Americans pay aren't set by politicians, they're set by markets.
Wall Street really doesn't want the oil industry to be pumping more oil.
If you look at the U.S. shale industry, they need prices more towards $70.
U.S. shale very clearly is in its twilight. By that, I mean the best days are behind us.
The U.S. is already producing more crude oil than any other nation in history. Does it need more? The cost of living is directly tied to the price of oil.
The price of energy does factor into the price of everything because energy is an input into most parts of the economy. When oil prices go up, often that sort of fuels inflation. Oil prices go down, that actually tends to reduce inflation.
Take, for example, gasoline.
Price of oil affects the price of everything that's made from oil, so gasoline, jet fuel, diesel, plastics, and so on, all the various products that you make from a barrel of crude oil. But of course, then indirectly, because so many goods have to be transported around the country, if the costs of oil go up, the cost of those fuels goes up, then the cost of all of those goods goes up as well.
Gasoline prices vary depending on where you live. Gasoline tends to be cheaper in areas close to refineries, like Texas and Louisiana. States with more regulation and higher transportation costs have higher gasoline prices. About 52% of the cost of gasoline is determined by the price of crude oil. The rest is determined by taxes, refining costs, and marketing. These prices fluctuate often, but adjusted for inflation, the retail price of gasoline in 2023 was fairly close to what it was in 1950. The price of oil is also subject to trends in supply and demand.
In economics jargon, people talk about consumption of oil being quite price inelastic. If you need to drive to get to work or to get to the store or whatever, it's not something you can easily do without.
Gasoline prices are expected to fall by 11 cents through the end of 2025 and another 18 cents through 2026. The cost of gasoline is falling as crude oil prices fall and fuel economy standards in the US rise. In other words, demand is falling.
You're getting the lower gasoline and the lower crude prices, but for the wrong reasons. That relief you're getting at the pump is really not necessarily the way you want to get to lower inflation and lower prices.
Adjusted for inflation, oil is actually kind of cheap right now. It's about 20% below the long-term average. The oil industry is really sort of caught in a bind here. We hear from various presidential administrations over time, we need to pump more, we need to drill more. Those decisions are made in the boardrooms and they're made on Wall Street. They will not drill when it's not profitable. Right now, with low oil prices, I think what we're going to start to see is a lot of companies starting to pare back on their capital spending.
In 2024, energy producers reported a break-even price of about $64 a barrel. The break-even price reflects the prices that producers must sell at to make drilling new wells profitable. U.S. crude oil prices are hovering below $70 a barrel.
More barrels does not necessarily mean more profits. If deregulation allows the oil and gas industry to produce more oil, more gas, what we may see is lower profits for the oil and gas companies.
The spot price of oil is expected to hover near $71 at the end of 2025, with increases in the coming years. If this forecast holds true, more companies may have an incentive to drill. Setting up a site to drill oil takes a long time. Up to a decade.
Oil and gas companies had to wait longer under the Biden administration than they had to wait in the past in order to get their permits approved.
Still, there are over 5,000 applications for a permit to drill pending. The Trump administration did not respond to CNBC's request for a comment on this story, but they reportedly want to expedite the permitting process, specifically on land owned by the federal government.
When you look back at the data, there was still a lot of activity on federal lands under the Biden administration. And in particular, think about New Mexico during the Biden administration, production rocketed.
Roughly 1/4 of crude oil production in the U.S. occurs on federal land.
The US federal government owns vast areas of land across the country, particularly in the West. And the Trump administration wants to make it easier for oil and gas companies to operate on that land. It wants to lease more of that land to them and award permits for drilling and other activities more quickly than they've been awarded in the past in order to reduce costs for the industry. And same goes for federal waters offshore as well, off the coast of the US.
Many of the targeted federal lands are offshore. The Outer Continental Shelf includes land off the coast of strategically important places like Alaska. ConocoPhillips, a major oil producer, has plans to develop a project in the National Petroleum Reserve in the northern part of Alaska. In 2008, the U.S. Geological Survey found that the project area contains 896 million barrels of oil. ConocoPhillips says the Willow project could yield as many as 600 million of those barrels. The U.S. is also planning to expedite the permitting process for a $44 billion project to extract natural gas on the north slope of Alaska and pipe it to the Kenai Peninsula. The pipeline would take energy from Alaska into Pacific countries like Japan and South Korea, and it's seeking investors.
I think that project has some other significant logistical and technical challenges. The weather is terrible. These kinds of pipelines often go over budget because they have to build this massive pipeline across the melting tundra.
The Trump team is also considering how environmental regulations affect the pace of oil production.
NEPA is the National Environmental Policy Act, and it goes back to the early 1970s, and it's really one of the foundational environmental laws in this country. The reality is that over the last couple of decades especially, the statute has been increasingly abused. Almost every project that the federal government has a role to play in has to go through a NEPA process. 40 years ago, that process took a couple of months. The modern form is that review process takes multiple years.
The United States is a net exporter of crude oil and petroleum products. This affects the prices that Americans pay.
Exports tend to increase prices.
Since 2019, the U.S. generally exports more petroleum and crude oil than it imports. This change was driven in part by two technological breakthroughs: horizontal drilling and fracking.
Unfortunately, fracking also comes with some fairly significant downsides.
Fracking also produces methane.
Methane drives nearly a third of the warming that our planet is experiencing right now. We see the value of the development today, but we're accumulating this large bill of environmental costs. The good news here is that oftentimes reducing methane pollution from the oil and gas industry has a net payback. And that's because methane is natural gas. If we capture that methane rather than putting it in the atmosphere, we're capturing something valuable that can be put to productive use in the economy.
About 60% of the homes in the U.S. use natural gas for heating, cooking, and other tasks. One of President Trump's actions calls for the expansion of liquefied natural gas exports from Alaska.
The more we export of natural gas, the more we import of high prices, price spikes, and volatility. Right now, we're seeing a surge in exports because new facilities are coming online. And what that means is that U.S. gas consumers, whether they're using gas in their homes, or if you're an electric utility or a data center that wants power, gas prices are going up.
The government expects U.S. exports of liquefied natural gas to increase through 2028. Analysts say this forecast could mean higher residential natural gas prices in the United States. The U.S. will also rely on imports for some of its oil supply.
We talk about oil as if it's all one kind of substance, but it's not. Many of the refineries that were built in the United States were built after they handled heavy oil that we're expecting to get from Mexico, maybe from Venezuela, from the tar sands in Canada. One of the results there is that we export a lot of the oil that we produce, and we import heavier oil that our refineries are set up to profitably handle.
The risk of tariff-driven trade wars could affect oil and gas companies' bottom lines.
It raises U.S. steel prices. It costs us more to drill wells.
For example, the U.S. under Trump may still rely on OPEC nations like Saudi Arabia.
OPEC was set up in the 1960s to manage Middle Eastern supply, and while many have said that the influence of OPEC is waning, It's pretty clear that the group still has a significant call on prices. The Trump administration has really caused a stir within OPEC.
And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down.
But of course, for Saudi Arabia, they too have a domestic mandate. They need higher oil prices in order to achieve their huge infrastructure spending agenda.
Oil producers in Saudi Arabia have higher break-even prices than those observed in the United States. This is an incentive to produce less, not more.
It means that the kingdom is really in between a rock and a hard place.
Other producers in OPEC are feeling the squeeze too. For example, the US has levied numerous sanctions on Iran, threatening to collapse their state-controlled oil-producing assets in the process. Back in the States, analysts believe that the fracking boom could soon slow down. The industry has consolidated in recent years.
One of the main reasons that Pioneer sold, we had a choice. People don't talk about the fact that we're running out of inventory. And the question is, where is oil prices going? There's too much supply in the world.
These global forces will influence what Americans pay for energy, perhaps more than executive orders coming from Washington.
You sometimes hear about the US being self-sufficient in oil, which is kind of true, but only kind of true because the US both imports and exports a lot of oil. The US is very much a part of the world oil market. And so if prices change anywhere in the world because the supply-demand balance is changing anywhere in the world, then that affects American consumers.
This is a real challenge to get oil prices at a level that producers are comfortable with, but also that consumers can live with.